congratulations on what has turned out to be an exceptional quarter, a very strong first half. What has gone behind this?
Firstly, thank you for having us on. We are also equally pleased about the result. This has obviously come about because of very good products that we introduced across various markets. In this particular year, and particularly this quarter, we saw a ramp up of tolvaptan that we had actually introduced in the previous quarter. It did obviously clock a pretty good number, but this is not the only thing. We had mirabegron in America, which continued to do very well. So therefore, America obviously totaled up a pretty large turnover, about $300 million. Likewise, you found secular growth across various markets. India also did very well, 8.8% in India, the domestic business itself, despite the fact that we lost exclusivity on a couple of products out here. Dapaji flows in Brazil, that was a big one for us from the emerging markets, so that actually did extremely well. Lufobec in various parts of Europe continue to do very well. So as you can see, it's been secular growth across various markets that has contributed to this. Apart from that, of course, there has been this incessant focus on costs across various lines. Clearly, that has helped about bringing about the EBITDA improvement, reaching an all-time high for across the business.
Yes, most certainly. I'm making the points as you tell me this, but Ramesh, so let's start first with the business side. And as I note, the highest quarterly sales recorded since Q3 FY17 in the US, right? And presumably, at least our assumption is that a lot of it has got to do with some new launches for which you have some exclusivities going on as well. Would that be a fair assessment? And therefore, if so, does this last for the next 1, 2, 3, 4 quarters?
So clearly, as I said, it is essentially because of mirabegron and tolvaptan. So those are products which actually have exclusivity in America at this stage. But as you would recognize in the case of generics, you have a huge upside on launch, and thereafter there is a downside. So this exclusivity period lasts about 6 months. So potentially you could see this coming down a bit in the fourth quarter and the like. So clearly, it is something which will, we hope it will continue for a long time, but it's really dependent on the kind of competition that you see for products over time.
Okay, and therefore, maybe there could be quarterly gyrations here and there, but would the launch pipeline give you confidence for, let's say, FY27 or FY28 or the next few years?
That is indeed the case. So we are building up a pretty rich pipeline for America and, of course, other geographies, so that we are able to kind of sustain growth over an extended period of time. So we have pivoted to more complex stuff over time. So clearly, the respiratory portfolio, you have, in fact, an array of products from the biosimilars front as well, complex injectables, and, of course, the specialty. Essentially, clearly, we are focusing a lot on more complex stuff, and that would help in sustaining the margins over time. There would, of course, be periods of volatility amongst quarters and the like, but clearly because of the fact that it's not as though every product will be there forever. So essentially, that period of volatility would be there amongst quarters, but the secular growth is what we expect over a period of time.
The one question is about the biosimilar and the long-acting injectable pipeline, right? When does that start contributing, quote unquote, materially to revenues, Ramesh?
Clearly, we have started filings across various injectables. We spoke about, in fact, Risperdal Consta. We have liraglutide. It was the first amongst, in fact, the Indian peers, so to speak. Speaking about, in fact, Risperdal Consta, it came out of our Nanomi technology based out of Amsterdam, out of Netherlands. Clearly, that's a unique platform that we have for nano platforms. So clearly, micronized polymers. And we are looking at a host of other molecules which would potentially be released over time. And speaking about, in fact, biosimilars, they are coming of age, principally because the fact that there has been a change in terms of regulatory framework in America, the most important market. So clearly, the reasons would be, there's interchangeability possibilities. Second, there is also the possibility of, coming out with private labels. Therefore, dispensing with the need for your own sales force Third, most importantly, is the fact that instead of PD studies, you could actually look at biomarkers, instead. So that would actually mean that you'd be able to kind of bring down the total time involved in terms of development and ease the entry of biosimilars in markets. Clearly, with that kind of framework, we believe we are very well positioned to take advantage of this and come out with products.
Okay, so before I talk about what the US actions might have an impact, or maybe I'll do that, Ramesh, and then get on to margins as well. Biosimilar fast tracking approval has come about in the US, if I'm not wrong. Does that help you materially? Is that something that you take advantage of in the current year itself?
Clearly, I think over the next 5 years, it is going to be a pretty large contributor to our total revenues in America. It's not necessarily something that I would take advantage of at this stage, not this year for sure, because we have made submissions to the authorities. These have to get approved and the like. But clearly, we are banking on this coming through over the next 5 years. And that's the confidence for sustainable growth over time and the like.
Okay, and anti-obesity, if the drug prices are coming off, is that any impact for you in the course of the next 12 to 24 months?
It's a big opportunity across various markets. So we have obviously are positioning ourselves for semaglutide GLP-1 in India and South Africa at this stage. We'll be amongst the early entrants. But clearly, this market is opening up in other geographies also. So naming here Canada, Brazil, Philippines, China, apart from India and South Africa. We are actually positioned for South Africa and India. But clearly, we believe that's a big opportunity given the fact that we are a pretty dominant player in India when it comes to the diabetes space. And we would take advantage of that for sure.
Okay. Now on to margins, Ramesh. And you started off the interview by saying that the incessant focus on costs has helped you clock in the margins that you have. This is what the highest margins I believe that I have seen Lupin clock in. Now, there are two questions therefore rolled into one. One, what's the outlook like with this incessant focus on cost? Can you actually amp this up more? And two, naturally, so I will ask you that relative to the guidance that you had given for margins, you are way ahead in the first half. Are you upping the guidance there?
So let me answer both. Firstly, when it comes to the focus on costs, it's across all lines of the P&L, so to speak. Speaking about, in fact, gross margins, apart from the buoyancy on the top line, we're clearly focusing on, in fact, alternate vendor development, routes to synthesis, rationalization or improving upon the productivity across the workforce, be it sales or be it R&D or manufacturing, addressing the footprint. And we had inefficiencies in our supply chain leading from and starting from, in fact, failure to supplies and the like, write-off of inventory and all of those. So there has been, tremendous progress over the last several quarters, clearly visible in the margins that we are kind of posting. And that focus will certainly continue. Speaking about, in fact, margins is actually a function of three things. Firstly, in terms of the kind of products that you bring to the market. Second, of course, the cost. And third, R&D. In terms of the products, I just did tell you about the fact that you might actually find some of these products weaning away over time, given the fact that that's the nature of this industry. So clearly, margins would come down a bit, so it's clearly above what we kind of guided. But for the full year, I think we would close to about 26% mark because the second half, there would be some weaning of margins. But clearly for the next year, we are plugging for something between 24 and 25%. It is a function of course, the kind of products that you bring to the market, the R&D expenditure, and of course, the cost factors as well.
Okay, and thank you for the candor, Ramesh, because I think it helps that the street not get overly excited by the number reported in Q2. It's phenomenal and kudos on that, but I'm glad that you're putting this into perspective so well. I have one final question, Ramesh, and that is on the CapEx. Now, if I'm not wrong, the quarterly CapEx spend was the highest maybe in the last 4 years. What's going behind this? I'm sure you're trying to build out a pipeline, doing everything, but is this the new Lupin? I won't call it a new Lupin, but is this a Lupin 3.0 or 4.0 or 5.0, whatever it is, wherein the CapEx spend will go up as the opportunity size increases?
No, actually, we are very focused on the kind of capital expenditure, of that matter, capital allocation in our policies, really. So this capital expenditure increase that you're speaking about, alluding to, is really, for a lot of maintenance capex and some capacity increase. As you know, we also have committed to actually a new facility in Florida, in the vicinity of about $70 million overall in a spread over time. So clearly, it's not as though there is going to be a huge overrun or increase in costs on capex spends over the next couple of years. It's going to be within very, very controllable ranges. And clearly, we are focused on actually delivering value to the shareholders, and the denominator in terms of the total capital employed is something that we are very conscious of.